So this is a stock on which I made 1.70% return. Now I took two positions in this stock. Each position was 2.5% of my portfolio. So let us discuss why I bought this stock, where I bought the stock, and where I sold the stock. And most importantly, why did I buy and why did I sell? So first thing, I bought it on this day. That was my first position. So let me place this tool here. So this is what I saw on the day I was buying the stock. You see nice consolidation here. This was election day in India. So nice consolidation. See price tightening on the right side. This is exactly what we want to see in a consolidation. Price tightness as well as volume contraction. So nice price action. So first reason why I bought the stock is, see blue, green, red. The 50-day is above the 150-day and the 150-day is above the 200-day. As long as I have the blue, green, red combination in that particular order, for me, that's an uptrending stock. For me, that's a stage 2 stock. So I'm interested in the stock. But that's not the only reason. That is just one of the reasons. The second reason is you have a nice base which has minimum 10 candles. So the base starts from here. That's 0.1, the high of this candle. I start counting from this candle. So after 0.1, this is my first candle, second candle, 3, 4, 5, 6. If you count, there are more than 10 candles. 10 candles means 2 weeks, since there are 5 trading sessions in 1 week. So 10 candles means 2 weeks of consolidation, which is the minimum that I am looking for. And that's what I have here. That's the second reason. The third reason is if you draw the base, if you draw the contractions in the base, see this is 0.1, this is 0.2, this is 0.3, 0.4, 0.5, 0.6, 0.7, 0.8. So you see there are 8 points in the base, which means 4 contractions or 4 corrections in the base. Now I am looking for minimum 4 points in the base. Here you have 8 points, which is double the number of points that I'm looking for. That means I'm looking for 2 corrections or 2 contractions in the base. But here I have 4 contractions, which is like an icing on the cake, right? So the point number 7 becomes my buy point, which is the high of this candle, since point number 8 has been completed. So let us draw a line there. So at the high of this candle, I draw a yellow line. That's my first buy point, whatever the price is. Okay. Look what happens next. Breaks out, triggers my order. Now I have 2.5% position in the stock. My stop loss is 8%, which is somewhere here. Okay. I'm not drawing the stop loss just for simplicity purpose. The stock continues to go up. See, you now have another buy point here. So this is 0.1. This is 0.2. This is 0.3, this is 0.4, and the high of this candle is 0.5. So I can draw another yellow line here to buy the stock. See, there are minimum 4 points in that base. So again, you have another buy point. So if you go forward, see, continues to break out. Now I have 2 positions in the stock. 2.5% position is. So I have total 5% position in the stock. 5% of my portfolio is invested in the stock. Now let's see what happens next. The stock begins to go up, goes up nice 3.26%. And then here you have a red candle. Now I decide here on this day, there were other stocks in my portfolio which were going down. So what I decided is I will close this position. So if I close this position, from here till here, roughly I made 6 to 7% return. So I was sitting on a 6 to 7% profit. So I decided to close my position on this day. I don't know exactly what price I sold, but I know that I sold on this day. So I remove this position, book a 6 to 7% profit. I keep this position because my loss on other trade has been compensated or offset. Okay. So now, since this position is already profitable, plus this is not high volume selling, which means the institutions are not selling. So I decided that let me be in the stock. Let's see what happens next. So I decided to give the stock some time. Look what happens. Now, if you read Mark Minervini's book, Think and Trade Like a Champion, the black color book, in that book, in the first or second chapter, he talks about something called as trade violations. In one of those trade violations concept, he says that after the stock breaks out from your yellow line, you start counting the next 5, 7, 8, 10 days. Okay. And observe the price action. That will tell you whether this stock is truly going to break out or whether the base is going to fail. So if we start counting after this, 1, 2, 3, 4, 5, 6, 7, 8, 9. Out of 9 candles, there are only 2 green candles, and this green candle is almost negligible. So you count it as a red candle. Okay, so there's not much price action here. So if 8 out of 9 candles are red, that means I have given the stock enough time to go up. It has still not come to my stop loss. So maybe my stop loss is somewhere here. Okay, so if I give it red color, that's the situation. So when the price came here, I said, okay, 1, 2, 3, 4, 5, 6, 7, 8. Out of 8, 6 candles are red. So I decided that I have given the stock enough time. I was going to exit on this day because it broke the yellow line. But since there was low volume, I decided, okay, let me give one more extra day to the stock to see if it bounces back and closes up above the yellow line. So I decided to give the stock some more room because now the losing trades were out of my portfolio and the other stocks in my portfolio were having unrealized gains. So I could afford that extra additional day of risk on this stock. So I gave it another day, continued to fall down on low volume, which means institutions were not selling, but the price itself was coming down. That was enough reason for me to exit the stock. So here I booked a loss of say 4.4, something like that, 4.4, 4.5%. So a profit of 6 to 7%, a loss of 4.5 to 5%. Overall, I ended up making 1.7% profit on a position size of 2.5%. Although I have took 2 positions, I am measuring my return on a 2.5% position size. So it's a tiny position size, tiny profit. But the most important thing is I did not lose money in the position. If I continue to do this on every stock, okay, if I continue to manage my risk tightly in such a fashion on every stock, chances are overall in the long run, I will end up making money or I will end up becoming a profitable trader. So this is the way I am managing risk. I study from other experts. Mark Minervini says you have to look for trade violations. Here, although the stock is falling, it is falling on low volume, which means what? The institutions are not selling. Okay, it's the retail investors that are selling, retail traders that are selling. So I could continue to stay with the stock, not a problem, but there is a limit to which I can allow the price to go against me. And on this candle, I said, okay, instead of booking 8% loss, why not book the 4%, 4.5%? So as long as I continue to limit my losses to 4 or 4.5%, I'm managing my risk correctly. I cannot allow every stock to go and hit my 8% stop loss. So that's the most important point. So I hope you understood the concept of trade violation here. The purpose of this video was to help you understand that trade violation concept, which is explained nicely in the book Think and Trade Like a Champion by Mark Minervini. Please read that book at least 3 times. Okay. So that's how I ended up making 1.7% on this stock. If you have any questions on this, let me know in the comment section. Thank you so much.